Futures trading involves substantial risk of loss and may not be suitable for all investors. Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the suburbs of Chicago. Today is Monday, October 27th, and we saw a lot of commodities come to life, a lot of volatility, both up and down across the board. Before we get into those markets that caught our eye today, I do want to remind you, if you've not signed up for a free trial of our daily commodity commentary, head over to bluelinefutures.com. From there, you can select the markets that most interest you, whether it be ags, precious metals, energies, indices, etc. We've got a great team that puts a lot of great information out each and every morning. And then on top of that, again, a reminder, we'll be doing the charts today on our Blue Line Edge trading platform, which is complimentary to clients. It is great for charting. You can trade from it. You can just monitor positions and quotes from it. And there's a desktop version as well. So some great tools to have in your pocket, no pun intended, if you're active or looking to get active trading these markets. Now that we got that plug out of the way, we can go ahead and get into today's markets. As mentioned, some volatility to the upside and downside. For grains, it was to the upside following kind of a renewed optimism that we're going to get a trade deal done with China. Now, we've seen these headlines kind of shift back and forth, almost like a pendulum, through the course of the year, where it's kind of like a positive trade headline, negative trade headline, positive trade headline, negative trade headline. But the recent price action, not just today, but really over the last week or so, seems to indicate that there might be a little bit more substance behind what's going on behind the curtain. And my professional opinion, I think China probably needs the soybeans as well. And U.S. soybeans are cheaper than their counterpart in South America, so it would make sense for China to buy some U.S. beans. It's cheaper for them, and they can say that President Trump got a trade deal done as well. So a few different facets playing into the market dynamic on that front, regardless of if that is actually what's happening or not, to be determined, but nonetheless, a lot of optimism today. We've got the December corn contract pulled up here. As you can see, this is that pocket that we've been talking about really, for the last several months. It's that gap that we partially filled last month, but originated from the gap lower following 4th of July weekend. So 430 to 432 continues to act as resistance, and that has played out yet in today's session. Potentially we set back a little bit here, but we're continuing to mark higher lows and higher highs. So I think we can eventually clear this hurdle. If we set back first or not is going to be the big question. If we do, you're going to want to defend some of these lower levels, these moving averages down near 420, 425. That's going to be a big support pocket to continue that trend of higher lows and higher highs. If we get out above 432 with some conviction and consecutive closes out above there, I wouldn't be surprised to see that maybe snowball the momentum up into the right on the chart. So that's what we're looking at for the corn market. Now we'll jump over to soybeans if I can get there. January soybeans, high price of the year, which is great. At the upper end of the risk range, we do have a little bit of a gap here that was left from the Sunday night trade, which is a little bit of a caution flag. But again, the price action over the last week and a half, I think indicates that we might get a little bit more substance on this news. Now, if you're a producer, that's probably a little bit different of a story. These are the best prices that you've seen all year, so you might want to consider playing a little bit more defense instead of trying to chase the market after such a sharp and meaningful rally higher. If just 2 weeks ago you were saying, man, if I could just get to 1080, 1090 January soybeans, that would be great. Well, here's your opportunity. So I think in this particular instance, it's about what hat are you wearing? Are you wearing a trader's hat or are you wearing a producer's hat? If you're a producer and long the market already, probably don't need to go ahead and Texas hedge, as they say, or double dip to the long side. From the technical and trading perspective, we're knocking on the door of a pretty big level. If we can get out above today's highs, consecutive closes, I think that opens the door for some potential movement to the upside. We've seen the way that funds can move these markets on the back of headlines with regards to trade, whether it be energies, the cattle complex, which we'll get to in a little bit, precious metals, etc. There seems to be a huge rush on the back of some of these headlines that come from the U.S. government. So if we do get a trade headline, potentially that's the catalyst to really keep this rally alive and not hit the overhead resistance and stall out. So headline's going to continue to be a very important factor in this market going forward. And then lastly, for the grain side of things, at least, we've got the wheat market, and wheat was kind of a sleeping bear over the last couple of weeks. Volatility near a 6-year low, daily ranges near a 6-year low, so it was very, very quiet, but got out above the 20-day moving average last week, and that sparked a little bit of optimism. And then today, getting out above the 50-day moving average for the first time since, I believe, June. So that really opens the door for some upward momentum here towards the 100-day moving average, which is this blue line that comes in near 539 and 3/8. Again, do we set back from here before we go back higher? That's always the potential in these markets after a nice little run. But ultimately, I think we are starting to carve out maybe a low in this market. So I think we continue to stair-step higher, higher lows, higher highs, and keep that trend alive. So I think there's still upside potential in these grain markets. Obviously, as mentioned with soybeans, headlines are going to be a big factor there. Now, moving over to the cattle complex, just continue to get absolutely slaughtered, no pun intended. Big breakdown in today's trade on the back of continued headlines, right? We got the headlines over the last couple of weeks about the U.S. government wanting to lower beef prices, and we talked about that as kind of a clear caution flag that, hey, if you want to be bullish this market, that's fine, but the U.S. government is trying to pressure prices lower. So you're basically fighting the U.S. government, which I guess, you can certainly do that, but you should know what your risks are in that scenario. And boy, have we seen those risks play out as funds continue to say, hey, I don't want to be involved in a market that the government is trying to pressure lower. So you're seeing mass liquidation. We had a lot of contracts limit down today. We do have expanded limits again tomorrow. Those are the normal expanded limits. They don't re-expand. So for live cattle, that's 1075. Feeders, 1375. Here we've got December live cattle. Had a tiptoed right around the 100-day moving average at the close. Finished a little bit below that. I wouldn't be surprised to see a little bit more trading back and forth in this market, but I think rallies will probably eventually get sold into. So trade lightly. These ranges have expanded, so your position should probably contract a little bit. Just stay nimble and don't get too crazy. The liquidity in these cattle markets, as we've mentioned over the last several months, it's a lot different than trading corn, soybeans, crude oil, or gold. It's a very thin market. You don't have the overnight liquidity. As you can see here, this is what happens in a thin market. You get a lot of volatility to the downside, and not everyone can get out on the day that they want to get out. So here we've got January feeders, lock limit lower for most of the day. Looking at the options market, synthetics, I think we're anywhere from about $9 to $10 lower earlier in the session. So do we see some follow through tomorrow? Wouldn't be terribly surprised. We did see a couple contracts come off of lock limit, specifically that November contract, which we're watching closely. So potentially we free up a little bit now that I think a lot of people probably got forced out of positions. So potentially we free up tomorrow. We can start trading a little bit more back and forth. But the volatility, again, as mentioned with live cattle, going to remain very, very high, so manage that risk appropriately. If you're looking, for counsel or, different strategies to play this market, don't hesitate to reach out to our trade desk. We are ready, willing, and able to help. And I think that sums it up for now. There are some other markets moving, but I think that's all we've got time for. So that is it. Again, any questions, give us a shout. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.